All right, Bill, thank you so much. And, thank you for everybody who's joined the call here today. We are so appreciative to partner with Levinson to be on this call and to be able to bring a talent like Joe Ross. So I'll introduce him in just a minute. But before we do, Bill alluded to a couple things going on from an AIG standpoint that are pretty exciting. And I have to say, I think it's a fantastic time to do business with AIG. We're doing some really exciting things. As I started thinking through some of the comments that I wanted to share with you today, a few things came to mind immediately, and they're very, very timely, such as a term reprice that we just got through with a week or so ago, where we really enhanced our term rates to stay competitive in the marketplace, a spot that we really want to make sure that we're constantly priced well and a good solution for your clients. But then on the permanent side, and particularly as it relates to IUL, we have some really exciting things going on there as well. We just released a cap enhancement, as much as 50 basis points. Our caps have gone up, and that's very unusual in the marketplace today. Most of the companies that you'll hear about are actually reducing their caps, not increasing them like we are here most recently. We have some unique riders that are unparalleled in the business, such as our select income rider, where we take a death benefit and we turn it into an installment payment. And in return for doing that, we will actually reduce the cost of insurance charges that are inside of that contract. We also have another rider called our Lifestyle Income Solutions rider, which is on our Guaranteed Universal Life, that provides a longevity hedge for clients that reach the age of 85 and are concerned about running out of money. So those are just a couple of very unique riders. If you guys have questions about those or potential sales that may involve those types of options, please reach out to your Levinson sales team, and certainly they'll reach out to us if we have some cases we want to take a look at. But last but not least, right now, we've actually partnered with Levinson to put out a 5% bonus to all of you for writing the Max Accumulator product. It is a very current thing that we've done. And in partnership with Levinson, we're rolling this out, and they've agreed to let us get on here and to tell the world, or the people that have joined, that on our Max Accumulator product, we are going to be releasing a 5% bonus on any of that business that you guys do with us. So that's a very exciting development that is hot off the presses here. So again, thank you for having me on. Really appreciate it. Just wanted to kind of throw a few things out there that are exciting. We really look forward to partnering with you and getting some sales done with all of you. But today we're super excited to be able to bring to you Joe Ross. And I know Joe has presented to this group before. Many of you may be very familiar with Joe and what he's all about. I won't go through a really formal introduction because I think many of you have heard him speak before, but I do want to make sure that I highlight a couple of really key things. Joe is an industry icon. For us, we get to see Joe get invited to main stage presentations at industry events and different meetings that go on, because he really has a way of breaking down really complex stuff and making it easy to consume and easy to understand and then easy to implement with clients. And before you all got on the call here today, I was saying I think he's one of maybe 3 people that I know in the industry that it has that kind of talent to be able to do that. So he does. He specializes in making complex concepts easy to understand. He's published in a whole bunch of places, including Broker World, National Underwriter, Life Health Pro, Think Advisor. And as I mentioned, he is a keynote speaker for conferences. Joe is a friend. He's a dynamic guy, and we're lucky to have him here at AIG. And so without further ado, let me pass it over here to Joe to get things kicked off.
Thank you, Eric. Give me just a second here. I see Andrew's given me the ability to go ahead and share my screen, and I'll need somebody there to let me know, is the screen coming through okay?
Yep, looks good, Joe. Perfect.
Okay, great. Fantastic. So let me step over to my screen, welcome to my studio once again, for those of you who've been here before. This is hopefully a totally unique and powerful experience for you to be able to see me actually standing in front of my PowerPoint slides instead of being a little box up in the corner that you can't even really pay attention to. You see the lovely mug shot of my colleague and teammate, Eric Tompkins, over here on the right, me over on the left. And what we're going to talk about today is a little bit to do with IUL volatility. And, in Bill's opening comments, he made some reference to the fact that they closed this big $1.3 million target premium case because of the current level of market volatility and the fact that the market is having a significant correction. It's not covered in today's topic, but it's in one of my other presentations that you may have already seen, but again, I'm going to reference back to it. One of the incredibly powerful things about indexed universal life in times like this is not only when the market goes down, you don't because of the 0% floor, but the other issue is this. Well, I'm going to pick some numbers out of the sky. Let's say you had $500,000 invested in crypto, and now it's worth 50 grand. That would be a big loss. In order for you to get back to where you used to be, just to make up for your lost ground, you would need that $50,000 to grow by $450,000 just to get back to your starting point. So your next $450,000 of growth doesn't get you ahead of where you were. It just gets you back to where you were. One of the most powerful things about indexed universal life is that when the market corrects and goes down, you don't go down. And when the market goes back up again, you go up immediately. You don't have to wait for the market to recover before you start getting credit to your indexed universal life account. Those two principles combined together, the elimination of the downside market risk and the elimination of waiting for the market to recover, are two of the most powerful concepts in indexed universal life, and they really shine strong in an environment like we're in today. We're going to talk a little bit more about volatility in indexed universal life today, because this is one of my biggest concerns. We run illustrations that show level interest rates. They don't show the actual volatility. We know intuitively that the purpose of indexing inside of an indexed universal life product is to take market volatility that looks like this and reduce that volatility with caps and floors and participation rates so that your client can have that market potential with much less volatility, and of course eliminating all of that downside risk and eliminating waiting for the market to recover. Unfortunately though, because we hear about caps, floors, and participation rates reducing volatility, which they do, and because we illustrate with a level interest rate in every single year of our illustrations, it sometimes causes us to forget about the actual volatility that exists inside of an indexed universal life policy. So today what we're going to do is talk about some of the things you didn't know about index market volatility and some of the things you can do within your indexed universal life policies in the vein of diversification that helps your clients overcome even more of the index market volatility. You're already overcoming a lot of volatility because of caps, floors, and participation rates. But I'm going to show you how we can use diversification to overcome even more volatility. What does that mean for your clients? Less volatility means more predictability of the results. And at the end of the day, when it comes to life insurance, if there's one thing your clients are looking for, it's predictability. And that's what we're going to talk about today. Now, when we get done today, you're going to be a little bit smarter. And when you're a little bit smarter, you're able to do a better job for your client. So let's get started and have a little fun. Everybody, thanks again for your patience as we play with technology. If it ain't one thing, it's another. All right, so here we go with our periodic table of investments for life insurance, and you will still walk away with some valuable lessons about how this stuff works. So you might remember back in, I don't know, high school maybe, when you were taking a science class where you learned about the periodic table of elements. If you've been around the investment community, if you've ever watched money managers deliver a presentation, they have something they call the periodic table of investments. And they call it that because it looks kind of like this high school science periodic table of elements. It looks like this. It's color coded and it has all these different investments on it. When you look over here in the first column on the left under the year 2000, what you see is we have a series of 10 different asset classes. And this is what the investment managers will do. They color code the asset classes so that if you pick an asset class and follow it across, you get to see the amount of volatility that any particular asset class might have. And their story there is to help people realize that there is volatility in these asset classes and they have to be aware of that volatility. Let me give you an example. One of them that I like to follow is these blue boxes that you should see a line going through right now. What are those blue boxes? Those are the S&P 500. And I chose the S&P 500 because, of course, that's a popular index inside of indexed universal life products. I know a lot of the hybrid indexes are becoming more popular today, but this focusing on the S&P 500 index will help us to learn the concept that you can then apply to your other indexes as well. So what you see here is the appearance of volatility by the S&P 500 as it is relative to the other investments. So what they basically did is rank the investments from the best performer to the worst performer in every single year. And you notice with the S&P 500, in every single year from 2000 to 2020, it was never the best performer, it was never the worst performer, it was always in the middle of the road, a little less volatile than many of the others. I mean, if you look at this one at the bottom left corner, the blue one, MSCI Emerging Markets, look, it's the worst performer down here in the very first year. Then it goes up. Oh, get that screen out. It goes up, then up, then up, and becomes the best performer through 2007. Then what does it do? It becomes the worst performer of the group. Then it's the best performer of the group. Then it's the worst. Then it's the best. Then it's the worst, and it trickles along the bottom. You can see the apparent volatility as it compares to the other investments. But here's where I learned a lesson that I really didn't see coming. I thought to myself, what if I redrew a line on this exact same chart showing the S&P 500 return relative to these other asset classes if I added a 0% floor and a 10% cap to the actual S&P 500 returns? My thinking was that when I put caps and floors on it, I would see even less volatility than I see here. But in fact, I got this. When I added a 10% cap and a 0% floor, I got what appeared to be even more volatility than I had without the caps and floors. Well, this is all a function of what can be misleading about this chart that the money managers use. And that's why I wanted to bring this out. You'll see fund managers that use this chart to demonstrate volatility, but it can be a little bit misleading. So what I did is took the actual returns. So let's just say take all these returns from 2000. I took all of those returns and I graphed them against 2001, against 2002, and on down the line. And what I ended up with is comparing the actual returns, and it looked kind of like this. Now, most of you remember that in 2000, 2001, and 2002, we had this little thing known as the dot-com bubble burst, and most of the returns of most asset classes were negative in 2000, 2001, and 2002. We bounced into 2003 through 2007, and the market did pretty well until we got to this big bad boy right here in 2008, the big market recession. Everything went in the toilet that year. But then for the next roughly 10 years after that, look at that. We had some pretty good market performance for the subsequent 10 years after that. But so what I drew here is a blue line that takes the average of all 10 of those asset classes so that you can see the volatility of those asset classes. None of these have any caps or floors on them. And here's where I wanted to show you some of the true power of indexed universal life. If I put the 10% cap, the S&P 500 with a 10% cap and 0% floor, you get this red line. And you can see it's far less volatile than these asset classes are if they don't have caps and floors. But here's where it gets a little tricky. We live in a world that says there is a relationship between risk and return. We tend to believe that if I'm willing to take on more investment risk, I should be expecting more investment return. And conversely, if I'm going to ask for less market risk, I should ask for less market return. Well, when you look at these two lines next to each other, I think everyone on today's call would agree that the red line is far less volatile than the blue line, and you'd expect the returns for that red line to be less. Well, what are they? I took that blue line and I calculated the average annual return over that 20-year time period. And the average annual return for those 20 different asset classes came out to be just a hair over 9%. And then I calculated the average rate of return of the red line, the S&P 500 with the 10% cap and 0% floor. The average rate of return for the red line is only 5.83%. So dramatically lower return in exchange for dramatically less volatility. So now you think to yourself, if I wanted to grow money, what would I rather do? Take the risks and accept the volatility and get the 9% return of average investment classes without caps and floors? Or would I be better off to have the caps and floors and only get a 5.8% return? Which one should I do? Well, this doesn't really tell you the tail of the tape. What really tells you the tail of the tape is how well they actually perform. So what I did here is said, let's take all 10 of those asset classes and let's put into each of them $10,000 a year. And let's let them grow at the rates of return, both positive and negative, over that 20-year time period of all those other investments. And I got this graph. So what you see here in year 2000, that's all 10 investments growing at the year 2000 rate of return. There's all the investments growing in 2001, and so on up the line using the rates of return every single year. And what you tend to notice is that those 10 asset classes all kind of traveled together, and they all ended up in approximately the same basic neighborhood of value at the end of 20 years. Well, here's something interesting. I said, okay, what if I put $10,000 a year into the S&P 500 returns with a 10% cap and a 0% floor? Remember, the average rate of return of this group of investments that you're seeing here is 9%, while the average rate of return of the S&P 500 with a 10% cap and a 0% floor is only 5.8%. But the question is, how does it actually perform? And when you take a look at that, I'm going to draw on for you the red line, which is the S&P 500 with 10% caps and 0% floors. And what you see here, what fascinated me by this, is that the S&P 500 with the 10% cap and the 0% floor has a much lower average rate of return. However, it performed right on par with the average of the group. And what this told me is I could use the S&P 500 with 10% caps and 0% floors, have far less volatility, and still have similar long-term performance. Now, this is what Bill was talking about when he said he closed this big IUL case today. That was an astute investor who can understand what you're seeing on the screen right now today. And when you understand this and can explain to astute investors that by eliminating all market corrections and by eliminating waiting for the market to recover before you get additional credit to your IUL account, you can have outstanding performance with less volatility, even though your average rate of return is lower. Now, this is what happens when I show contributions. I thought, what about distributions? What if I had a client who had $1 million in the bank and now they're ready to retire and they're going to take money out of their portfolio and they're going to expose it to the same rates of return that we used in this example? Let's see what happens. So in this example, I've got an initial value of $1 million. I'm going to take annual distributions of $75,000 a year. I'm going to run it through that exact same 20-year history of returns and see what those 10 asset classes were able to do. And what you see here is really remarkable. As early as 2009 and 2010, you see that some of these asset classes have already run out of money. And in fact, some of these asset classes have gone negative to the tune of more than $1 million. You started with a $1 million positive and you're down to a $1 million negative after taking $75,000 a year out, exposed to those rates of return. Now, this could be devastating to your client. So the question is, even though these 10 asset classes have an average rate of return of 9%, how would my 5.8% average rate of return do in my index universal life with a 10% cap and a 0% floor? There you can see the line of the S&P 500, 10% cap, 0% floor. And what you see is by 2019, it didn't run out of money yet. It's less volatile and only a few of those 10 asset classes were able to outperform the S&P 500. The other 6 asset classes all did worse, even though their average rate of return is higher than the S&P 500. Now, this is really powerful technology to know regarding the power of caps and floors, the elimination of corrections, and the elimination of waiting for market recoveries. But let's take that one step further. So what's my point with all this? First of all, my point is the caps, floors, and participation rates that we have in Index Universal Life tend to dramatically reduce the volatility, but they maintain the performance. That's the key to indexing. Reduce volatility while maintaining performance. That's the power of IUL. So the next time you're thinking about it, ask yourself this question. Do you think your clients want this level of volatility or do they want this level of volatility? If they can produce similar results with the lower level of volatility, that's what your clients are going to want to do. Now, I'm not asking you to remember all this and be able to explain all of this to your clients. That is definitely not my point here. My point is to help you as agents understand the incredible power of indexed universal life versus a portfolio of non-qualified investments, which may have a higher rate of return, but because they have these significant years of negative performance, those averages don't end up producing results as good as you can get with an indexed universal life that has lower volatility and even has a lower average rate of return. But because you got rid of the market corrections and because you got rid of waiting for the market to recover, you actually perform as well or better in the indexed universal life. So that's a powerful story about indexed universal life overall, but there's also something that I've been thinking a lot about that I want to share with you about what goes on inside of an IUL policy. I talked about this a little on the front end, that because caps, floors, and participation rates tend to reduce volatility, and because our illustrations show a level interest rate in every year, we tend to forget that there still actually is volatility inside of an IUL policy. In fact, I went back and took a look at the S&P 500 returns from 1927 to 2018. Because what I wanted to see is how often does the S&P 500 return land between the 0% floor and the 10% cap? And how many times does it go outside of it? Here's what I found. 83% of the time, the S&P 500 return was either greater than the 10% cap or less than the 0% floor. Think about that for a minute. 83% of the time, the actual S&P 500 return over the last 90 years was either greater than 10% or less than 0%. What does this mean to the return that your clients would get in an IUL policy if they took the S&P 500 index with a 10% cap and a 0% floor? What would all of their returns be? All of their returns would be 10% caps and 0% floors. Only a few times would they have anything in between 10 and 0. And what that leads to is a significant amount of volatility. So let me walk you through that story. I'll start by using the same kind of idea as I did before. What I've got over here is starting in 2001, and I've got the three indexes that are most popular inside of the AIG max accumulator policy, the one that Eric was talking about earlier. The first index bucket is called the Merrill Lynch Strategic Balanced Account. It's called MLSB. The second one is called the PIMCO account, and the third one is the S&P 500 account. These are the three most popular accounts inside of our product. Now, the MLSB account, if you take a look at it, it has a 100% participation rate. The PIMCO account has an 80% participation rate, and the S&P 500 in my example has a 10% cap, although it's slightly higher now. What you see is 2001 was a really bad year because of that dot-com bubble burst. So the MLSB account, even with its 100% participation rate, only delivered a 1% return. The PIMCO account, with its 80% participation rate, only delivered a 0. In other words, it had a negative return, but the 0% floor rescued it and gave it a 0% return. The S&P 500 was negative in 2001, but the 0% floor gave it a 0% return. Here's what those returns look like if I created kind of a periodic table of index accounts, and you could follow. And this is something I want to help you understand. Some clients want to get the best return they can. And sometimes what we do is just pick the account that we think has the best prospects of doing that. In other cases, your clients will chase the returns. So let's see what happens if they do that. Let's just say over here in 2001 and 2002, they chose to use the MLSB, the Merrill Lynch Strategic Balanced Account, because it was the best performer of the three. So they'll put all of their money in the MLSB account, only to discover that for the next 4 years, it was the worst performer of all three options that they had available to them. In fact, where they should have probably been is here in the PIMCO account, but they were in the MLSB account. Eventually, after 4 years of being the bottom feeder, the worst performer of the group, you know what they said? I'm getting out. I'm going to go get something that's got a higher return. like maybe that PIMCO or that S&P 500, only to discover that immediately after they moved their money out of the MLSB in 2007, it was one of the best performers in the group. So what do? They move all their money back into the S&P 500, and what happens? The next year, everything gets a 0% return in 2008, and in 2009, the Merrill Lynch account ends up being the worst performer, and that's where all their money is. So they get frustrated. And they say, I don't want to be in that account anymore. I'm going to put my money back in the PIMCO account. What happens? In the next year, the PIMCO account becomes the worst performer of the group. And what became the best performer? The account they just took their money out of. And you can see how they could play this game over and over again throughout that 20-year period. If an investor is chasing returns based on what they see in their rear view mirror, they will continue to guess wrong, just like I described there. They could have done the same thing with the PIMCO. They could have picked the PIMCO and got into it and then stayed in it while PIMCO became one of the bottom performers during the later years. Same with S&P 500. It was one of the poorest performers for the first 11 years, but it was the best performer 3 out of the next 5 years. How do you know which account to be in? What does this tell you? It tells you a couple of lessons. First of all, we never know which index is going to perform best next year. I don't know which index is going to perform best next year, and neither do you. And the second thing it tells me is there may be even more volatility in index returns than we think. Let's take an example. Take those returns, put them on a graph, and let me ask you, do you notice any volatility here? The green line that you see here, that is the PIMCO with its 80% participation rate. This blue line that you see here, that's the Merrill Lynch Strategic Balanced Account with its 100% participation rate. And this yellow line that you see here, that's the S&P 500 with a 10% cap and a 0% floor. Look at the volatility we have here. We have returns as high as 18% and returns as low as 0%. Even though these are the returns that take place inside of an index product, and we like to believe that there's less volatility, you can see there's still significant volatility. Here's what unnerves me. When we run an illustration, we choose an interest rate like what you see in this red line, maybe 6%. And we illustrate that as a level interest rate in every single year. And that looks fine on an illustration, but you know what happens the day after your client purchases this IUL policy? They will probably never see a 6% return again for as long as they live. What they are going to see is zeros when the market goes upside down, and they're going to see high returns in these years where the market does well. So the question is, are your clients prepared for the volatility they're going to see when they purchase their IUL policy? What's going to happen to your client if they bought their policy in 2000 and you illustrated a 6% return, and in their first 2 years, their return was 0? What's your client going to say? What are you going to say to your clients in response? Those are the kinds of things that I want you to be prepared for, because there is volatility. So let's take these same returns, these returns that you see here, these volatile returns of these different indexes, and let's do what we did before and take a look at their actual performance over time. I'm going to do the same thing. Annual contributions of $10,000. I'm going to put them in each of those 3 indexes and see how they perform over a 20-year period of time. And what you notice is that they all perform pretty closely. They all ended up in a pretty tight-knit ending value. $368,000 for the Merrill Lynch account, $380,000 for the S&P 500, $409,000 for the PIMCO account. Not much difference between these. Even though they were all very volatile, there wasn't much difference in their performance. But here's what's interesting. What did you illustrate? If you illustrated a 6% rate of return, your 6% rate of return would have given your client an expectation that was below what actually happened. Is that good news or bad news? That's fantastic news. It's fantastic news because your client was expecting $337,000 and they got $368,000 or $380,000 or $409,000. They're delighted because they got better than they expected, better than you illustrated. But let's also take a look at the distribution side of the story. So again, I've got $1 million. I'm going to take out $75,000 a year and see how these 3 indexes would have performed. And now you can see that the difference between how they performed got a lot bigger. Noticing that the S&P 500 was down at just $190,000. Merrill Lynch was at $315,000, and the PIMCO account, wow, $700,000. That is a $600,000 difference from the top to the bottom. By the way, If you had illustrated for your client a 6% return, that would have had a projected $493,000 account balance after taking those $75,000 distributions for 20 years. Now, is that good news or bad news? This is really good news. Actually, let me take that back. This is actually bad news because your client has an expectation of having $493,000 at the end of the day. If they were in the Merrill Lynch account, they'd only have ended up with $315,000. If they were in the S&P 500 account, they only would have had $192,000. They were expecting $493,000. In this scenario, you would have had a very disappointed client. Now, what's my point here? I want you to recognize that the performance of the indexes during the accumulation phase is much different than the performance of the indexes on the distribution phase, and be aware of those differences. So here's an idea, and we'll wrap up with this idea. What if we took these three index accounts? This is the exact same chart you saw a minute ago. And what if we blended them 1/3, 1/3, 1/3? That's what you get here with the red line. It's a 1/3, 1/3 blend. So I've got 1/3 of the Merrill Lynch account, 1/3 of the PIMCO account, and 1/3 of the S&P 500 account. And what you notice is that other than these years where everything went in the toilet with zeros, it is the least volatile of all of the options. So what you've done here is instead of putting all of your clients' money into just one index, if you diversify across multiple indexes within your IUL product, I don't care whose product it is, whether it's AIG's or any other of the fine companies that are on the list of products you can choose from through Levinson, if you can blend and distribute their money across multiple sub-accounts, you get less volatility. Let's go back to our graph of the $10,000 annual contributions and see what happened. I've added the red line, which is the 1/3, 1/3, 1/3, and what you see is that it dropped right into the middle. It fit right in there with the rest of the accounts. Remember that your projection at 6% was $337,000. Your 1/3, 1/3, 1/3 mix produced a return of $386,000. Is your client happy when they expected $337 and instead they got $386? Of course, they're delighted. That's what can happen when you blend the accounts. And when you look at the distribution side, where I've got $1 million and I take out those annual distributions of $75,000 a year, inside of those index buckets, look what happens. Again, we've got the same disparity, but this red line is what shows me what happens if you did a 1/3, 1/3, 1/3 blend. You outperform the S&P 500. You outperform the Merrill Lynch. The only one you didn't outperform in this case is the PIMCO. And if you had run an illustration, the illustration at 6% would have suggested $493,000. With the red box, you would have had $414,000, very close to what they were expecting in their numbers. Again, what is the key point here? The point is, I want you to consider diversification within your IUL policy. By diversifying across the sub-accounts, you reduce the volatility and you'll increase the predictability. So the next time you illustrate a rate of return that looks like this, 6% level every single year, just remember that the day after your client actually purchases their IUL policy, they're going to start seeing returns that look more like this. Make sure you're prepared. Make sure your clients are prepared for the actual volatility that they're going to experience when they open up that envelope and see their annual statements. This is information that makes you a smarter agent, makes your client a smarter buyer, and makes your policy perform the way they want it to. And that's the story I wanted to share with you today, understanding this volatility. And that's the key takeaway, knowing that there still is volatility inside of Index Universal Life products, and that it's perhaps dangerous for you to put all of your clients' assets in only one index inside of their IUL policy. It's quite, in many cases, it's quite a lot better for you to diversify across multiple index buckets inside. So that's my story for today. I'm going to turn it back over to the team at Levinson. I'm sorry that we're running a little bit over today because of the technology hiccups we had, but I'll leave it to Bill to go forward with the conclusion of today's call. Bill, back to you.
Yep, no problem, Joe. You did a great job considering, and we're definitely going to set this up again in the near future. So I'll talk to Eric about that.